Markets are at an all-time high, and if the market corrects severely, then it will be very unnerving.
Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Sensex is recording new highs each day. It's scaling new peaks every day. But what is behind this rally? How expensive is the market right now? And what should be your strategy in such a scenario? Should you invest? We'll talk about that in today's episode. Keep watching.
Variety of factors. Foreigners are back, domestic investors have continued investing money, and Indian companies are growing faster, better. India is proving to be an island of growth in an otherwise gloomy world. And foreign investors who walked out about a year ago or when interest rates went up, they are coming back looking at India as an island of growth in a gloomy world, and in a substantial flows coming in. So all these things combined together is driving the market. We were looking at the state of the market when it attained an all-time high and a significant milestone. And the biggest number we saw was 4,631 in September 94. And the market tanked thereafter. And it took nearly 5 years for it to recover fully. And the second longest one was in February 2000, when the market was at 5,900, nearly 6,000 points. And it took nearly 4 years for it to get back to the same level. So markets at an all-time high when you invest, and if it gets into a tailspin, then it takes, the longest it has taken to recover it fully is about 4 to 5 years. If you catch a market high, then it can well take up to 5 years, and as it has taken in the past. But all past is actually of no use, because every past has a context, and today's context could be very different from the context of the 90s. But I think important thing to notice is that, what has been the kind of fall that happens when you catch a market high. And catching a market high is something which every investor should worry about. Not because you lose money, because it can have a very big effect on your psychology in the way you approach market in future and the way you experience it. So if I look at what has been the scale of decline, the biggest decline that we've witnessed was during the period 8th January 2008 to 9th March 2009, when the market came down from the levels of 20,000 in January 8 to 8,100. This is a 61% decline. So imagine Sensex going down by 61%. And 61% is quite scary, quite unnerving. Your 100 rupee becomes 40 rupees. It takes great effort to reconcile with that. That is the time when most investors panic. And the second instance we came across was a 56% decline. That happened in February 2000 to September 2001. This was again a massive decline, but before that, the market hadn't gone anywhere. In case of 2008, there was a situation that the market went up by 5 times. So it was not as hurtful for any medium-term investor. But in February 2000, it was a massive blow to investors because market hadn't gone anywhere for a long time, and then it steadily declined by 56%. When we look at the decline, this massive decline, the 61% decline in 2008 to 9, it took nearly 4 years for it to recover. So if you would have invested at the height of the market in January 2008 and you would have done nothing, your money would have got reduced to 40 rupees, 100 rupees becoming 40. And then you will have to wait for nearly 4 years for you to break even. And then in this situation, it gets very difficult for you to have patience, to manage your manage your own behavior. So if you catch a market high, if you invest big time, and you end up only with hindsight, you will get a sense that you did invest at the high. It is very difficult to make a statement about the state of the market in terms of whether it is expensive or cheap. But very vaguely speaking, very broadly speaking, if we look at the conventional yardstick, price earning ratio, and all other metrics on which the market is evaluated on its valuation, I would say that market is just about reasonably valued. It is not very expensive. We are not coming across companies which are trading at prices which looks unacceptable. No investor should ever be guided by the movements in the market simply because you have no control on that. You should mount a strategy. You should have a plan which is in your control, which is where the factors which will determine your direction or your investment performance should be completely in your control, not the market. It is very difficult to resist this market. It is very difficult to get scared for the reason that markets can come down. It is very difficult to actually get greedy at this point because markets are going so frantically every day that you have this feeling of having missed out opportunity. So don't get carried by this. Work on a plan for yourself and stick to that plan. Asset allocation and your investment time frame becomes very crucial. First and foremost, don't invest at one go. The way the market is going up, everybody will be tempted that let me ride this market quickly, and why spread the money over time. This is the kind of market where some of the big investment mistakes are done. So avoid that. The first thing to do is not to invest at one go a large sum of money in equity just because it's going up. Even if it translates into a missed opportunity, let it be. Second is that if you have accumulated something meaningful, if your accumulated investments in equity is sizable now, and by sizable I would mean something like your 4 years earning, and if it is 3-4 years of worth of earnings, then maybe work on your asset allocation plan. And if your investment time frame is still 10 years, 15 years, 20 years away, maybe have a small allocation to fixed income. 15%, 20%, 25%. But have that so that you are able to take your money out when the market is high from equity. And you will have that money if the market goes down. So you'll be able to benefit from that. Likewise, if your investment goal is somewhat closer, then you have to decide that whether it should be a nominal sum, it should be a small part of your money should be in equity, or and the rest of it should be in fixed income. That will amount to moving a large part of your money from equity to fixed income. And the way to do it is you will have very serious, deep regrets if you do it immediately. Don't do it immediately. Do it over the next 6 months. Devise a plan that how much money you would like to move from equity to fixed income in a methodical way. And there are two advantages of this. One is that if market comes down, you will have less regret. Second is that you will have money in fixed income, or money which will be available to be invested in equity if markets come down, because you will be able to rebalance again.
That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.